Hey, good afternoon, everyone. Um, I hope everyone's having a really great day. Fausto just gave a awesome presentation, and this is Mark from Right Line Trading, and I'm going to talk to you about our money flow tracker. Now, in my opinion, I believe it's really the only profitable way to trade the markets. Now, I want to follow up by this quick disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers for educational demonstration purposes only. That Right Line takes no responsibility for profits or losses. And everyone understands that trading the markets involves substantial risk, and it's not appropriate for everybody. Always carefully consider your financial position, do your own due diligence, and here at Right Line, we're not registered financial advisors and we're not licensed commodity trading advisors. Now, who am I and why should you listen to me? I mean, there's literally dozens and dozens of gurus out there, all proffering trading systems to you. And really, pretty much like Fausto said, if you're going to have brain surgery, do you want to have it done by somebody who has no formal training whatsoever and really, just woke up one day with an epiphany and discovered a way to make $50 million? Well, I graduated from an Ivy League university. I went to the University of Pennsylvania, and I was there for over 8 years. I was inducted into the Phi Beta Kappa Honor Society, which is a given only if you graduate in the top 2% of your class. I was a full-time professor at Jefferson University in Philadelphia. I published over 15 peer-reviewed articles, and I consider myself first and foremost to be a scientist, a teacher, and an academician. I've personally mentored more than 30,000 traders, and I've spoken internationally in over 30 countries. The last country I spoke at was in the Philippines. It was in Manila, in the Philippines, and I got out of there right before the COVID epidemic really struck home, and a lot of people in the airport were just starting to wear masks. Now, I just want to also mention that in my undergraduate and graduate training, what I did was major in applied mathematics. Now, what do most traders trade? If you trade Forex, you trade futures, or you trade stocks, what do 99% of traders base their entries on? Well, they base them on price action or price patterns. Everyone's always rolling back the curtain on secret price patterns. And really, pretty much, I have an AOL address where I send all my spam mail to, which is basically, I subscribe to everybody else's newsletters. 95 to 99% of what I get are people finding millionaire price patterns, new ways to trade Japanese candlestick patterns. And that's the reason why 95 to 98% of day traders and swing traders go broke. It does not matter whether you trade futures, Forex, or stocks. If you trade Japanese candlestick pattern formations and I always see new $1 million formations coming out there. Some of them are even patented, and I'm going to show you those. You're going to bust out of the market. Now, marketers have really nothing else to sell you. There's nothing new. And think about the science of day trading. If we look at any other scientific endeavor, what happens is that there's an evolutionary process. We embrace what works and we dump what doesn't work. So over the course of time, the science becomes more and more, people in that endeavor become more and more successful. I mean, at this point, if you were an architect and 95 to 98% of the buildings you put up fell down, I mean, society would have a big problem. And the reason architecture has become so successful is it started off with somebody putting two boards together, understanding the fundamental science of what keeps buildings up, of which I personally have no idea. But the bottom line is understanding the principles. And when you find one that doesn't work, you remove it. And when you find one that helps you, you embrace it. For some reason, this just does not happen in day trading and swing trading. Traders do not take it as a science, and they continue to use the same stuff that has been out there for 30 years. It's repackaged in a different box. It comes out with a different color bow, but it's all based on the same trading principles, and it fails. Now, here is pure price action, and these are Japanese candlestick patterns. Now, I've studied these until I'm blue in the face, and I really think that you should understand them, because they do teach you some really nice. They give you a fundamental understanding of how the market moves, and in some regards, they still have value. But if you're going to use them to try to become a consistently profitable trader, it's just not going to work for you. And there's a real reason why. And the reason why is that the Japanese rice traders, when they developed Japanese candlestick patterns, made an assumption. And the assumption they made was that the power of each buyer was essentially equal to the power of each seller. And that's what made this, all of the formations that you see, extremely valuable. Now, rice traders created this 400 years ago. And back then, for whatever closed system they were trying to describe, it obviously wasn't the market. Each person who was bartering for something had the same power as each person was trying to sell you something, and each person who was trying to buy something had equivalent power. That is just not the case anymore. Now, the same is true for every single market formation, including the secret ones that are revealed to you. Now, if we look at a falling triangle pattern, it's really based on market sentiment. We find out that we have sequential lower highs, sequential lows, and the anticipation is that price is going to break through the downside and continue down. And what we're assuming is that we're accurately making an assessment of how traders feel this market. Unfortunately, an enormous number of these patterns fail. Here's a falling triangle, price skyrockets out of it, and we're going to talk about why that happens. And remember, rising and falling triangles have been around forever, and we still have 95 to 98% of day traders and swing traders going broke. And here's a rising triangle. We have sequential higher lows, equal highs, based on sentiment of traders. We anticipate a breakout to the upside and a continuation of price going up. Unfortunately, again, you're going to get the breakout, and all too frequently, price just collapses. And again, we're going to talk about why that happens in a second. It's really based on the premise that the power of each buyer is no longer equal to the power of each seller. That basic principle and premise that underlies Japanese candlestick formations and all of these price patterns is no longer operational in the market. And if we continue to embrace what's been sending traders off the cliff for over 4 decades, we're just going to take that big jump off the cliff. Now, here's that J-hook pattern. And if I see that offered to me one more time, I said I'm going to turn blue in the face. And it's really based on a reasonable premise that doesn't work anymore. This could be a Forex, future. It takes a hit. And it's crude oil just taking a tremendous beating. But what happens is it falls to a multi-month, multi-year low. Maybe it's a stock that's missed earnings. Maybe it's a Forex pair where a country where the central bank of the country interest rates that is unfavorable to the value of that currency pair. It goes down to multi-month or multi-year lows. Then it forms a hook or fish hook pattern that, according to certain traders, may have made them hundreds of millions of dollars. The problem, buyers may come in initiation of move. But what happens again too frequently? Support, and once it does, it's in free fall. Because remember, you're breaking multi-week, year low, and once you break that, you really have nothing below you to support price until a long way down. And you better get out of that and move fast, or you can take an enormous beating on it. Now, I threw in Fibonacci levels because I consider Fibonacci, I call it the Fibonacci hoax. Now, how long has Fibonacci been around? It's been around for 40 years. And we still have 95 to 98% of day traders and swing traders going broke. Now, how was Fibonacci created? Fibonacci was I believe he was a 16th or 14th century mathematician. Doesn't really matter. I mean, it was hundreds of years ago. He created Fibonacci transformations, which led to the from the transformations, he developed Fibonacci numbers. And Fibonacci numbers describe certain symmetries in nature. They describe the number of edges on a snowflake. They describe the number of ridges on a pine cone. So they do actually tell you something about what's going on in the physical world. But to make the assumption that a Fibonacci retracement tells us market sentiment is ludicrous. To determine that this Fibonacci retracement, or this Fibonacci number here at whatever it is, 60, whatever it is, 0.8%, is going to tell us that if price comes down to it, buyers are waiting here to send price up, is a teleological leap in faith that is simply absurd, because it's not grounded in any kind in any kind of reasonable applied mathematics. It's just an assumption made that has never been verified. And as far as we're concerned here, we've looked at Fibonacci going back a year and find that these levels break or hold really at whim. And you can always make a case for fib numbers going back, going back. But if you think they're going to tell you market sentiment of the right edge of the chart, that's what's going to send you off the cliff. And I see new Fibonacci programs coming out all the time. And for some reason, it continues to have an appeal to traders. And maybe because it seems like it's complex and it has some kind of special merit. But the fact of the matter is, it doesn't predict market sentiment at all. Now, I don't have slides, but let's look at Elliott wave and Gann theory. Now, to their credit, they were both very, very brilliant mathematicians. And what they did was create mathematical formulas based on actual price movement in the market that they felt would describe market sentiment. Elliott's 5-wave pattern was based on a mathematical formula he derived from what he saw when he studied price action and market structure. The problem is he created this way back in the day when the power of each bear essentially equaled the power of each bull. The market consisted almost exclusively of us, the small retail trader. And when we trade the market alone, that 5-wave pattern probably had some value, just like divergence signals had value, but they don't anymore. You can't mathematically call a top or a bottom anymore. And if you trade divergence, it's the quickest way to the poorhouse as far as your trading account is concerned as you can get. And any piece of software that tells you it can mathematically determine or a top or a bottom is absolutely not, it isn't going to work. Now, this is a proprietary candlestick pattern, and I've actually been told this has been patented. Now, I'm not giving you away any secrets because I just attended this man's webinar, and I would never tell you his name. But this is a $2,000 pattern, which if you join, he's going to hone it down for you. He has a scanner that finds these patterns for you. It's a whole bundle. The bottom line, though, is the system is based on this 3-candle pattern. And what you have here is a bull failure. Bulls try to push the market all the way to the top of the candle, or top of the wick. Bears come in, push it down, you get a down close, and what this forms is a hammer. Then you get continued strong follow through. You're in 1 tick below the close of the candle, and market sentiment, or what he predicts, is that you're going to get a nice collapse in price. Now, the only thing that I ever ask other moderators when they show me their programs is what percentage of these formations work and what percentage of these formations fail. If you can't answer that question, then what you're talking about doesn't have any validity. So he wouldn't answer me. So what I did was I just did a look back on my own of 3 months, and I found my own patterns. And here's a bottoming pattern. And what you get is bears trying to push the market down. And this, doesn't have quite as big of a wick as the topping pattern did that I showed you before. But then bulls come in, you get this nice bullish follow through, you're in 1 tick above, and then you get nice move. But then you get a complete collapse in price. So the pattern doesn't hold up. And I saw an enormous number of patterns that failed. So the fact that he's telling me that he made a fortune trading this pattern, and although it's been patented so nobody else can sell it, is just really untrue. And it really goes back to my fundamental thesis that I'm telling you, is that all Japanese candlestick patterns and price patterns no longer work. And this is really the reason. Price action and price patterns have power, but they fail well over 50% of the time. And you're not going to make money trading them because that's what everyone else is trading, and no one is making any money. That 95 to 98% statistic is real. Most day traders and swing traders go broke. And if you've been at this and you can't make money, it's probably because you're trading some variation of this. You're calling tops or bottoms. You are trading price action. You're trading price patterns, because basically that's all there is to offer. Now listen, I'm not going to ever say this is the only program that works, but if it's based on any of this, it's going to fail. And the reason these patterns fail so frequently is institutional money. Institutional money now comprises at least 70% of all volume in almost all markets, in the futures markets, in the Forex markets, on any individual stock, on the ETFs, overall indices. It's the big money that determines the direction the price is going to take. And the price action, Japanese candlesticks, and price patterns that you may have been looking at prior to the kick-in of institutional money is just going to get destroyed. Elliott wave is going to get destroyed. Gann analysis is going to get destroyed because this big money is going to take price in the direction it wants to. So that's what we're going to do, is we're going to track the direction of institutional money. Now, what I wanted to represent in this slide was this big hand coming down and grabbing this candlestick, and either pulling it up or pushing it down is going to completely destroy anything you've seen before. So if you're trading these price patterns or Japanese candlestick formations, the power of the bears and the power of the bulls is no longer equal. You've got this massive single institutional trader, and they determine the trend. And the only profitable way to trade is to track this money. It's either a big bank, big institution like Goldman Sachs, it could be a big mutual fund. Whatever it is, it's something that controls an enormous amount of money. Now, again, way back in the day, when a lot of these things were valid, the market consisted, and these are just all small marbles, of us, all small retail traders. And we all had the same power. Then price patterns and Japanese candlestick formations, I believe, had validity. Now, this is before I ever traded, and probably before anybody ever traded who's listening to this session, because it goes way back. I mean, George Lane developed the first indicator in 1963. He created the stochastic indicator, and the only thing he used it for was to track divergence. And I believe in 1963, a divergent signal had power, because the only thing in the market were just all of us, the small retail trader. Now we've got this huge institutional marble, and whatever it does is going to determine the direction of price. Market sentiment prior to this guy stepping in will become irrelevant as it's expressed in the market using all the things I just discussed. So the system that calculates the direction of money flow is the one that's going to give you the winners. The big institutions and the banks rotate their money from sector to sector, and we track the sector rotation using proprietary technology. And what is sector rotation? Essentially, if you've heard of artificial intelligence, what it simply is telling you is that everything is interconnected. No stock, no Forex pair, no futures market trades in isolation. And that's because the big institutions interconnect them, and everything is related. Now, some of the correlations are very tight and some of them are weak, but artificial intelligence and tracking sector rotation is really the fundamental basis for these artificial intelligence systems, and they are correct. Now, if you stay to the end, I'm going to show you how you can get this. This is a stock scanner. It's actually a market scanner, because you can use it on stocks, futures, and Forex. Now, it's completely modifiable. It can be calibrated in minutes. It can, if you trade a minute, it can be calibrated in range. If you trade range, you know, in Renko, if you trade Renko, and you can look at multiple time frames, multiple range sizes, multiple whatever you trade. This could be a 377 tick, a 610 tick, a 1000 tick, and it's going to give you a buy sell signal on the trading chart speed that you trade. If you're trading a 5-minute, you have an entry on Apple. You're trading a 15-minute, you have an entry on Apple. You don't have an entry on a 1 hour or a 4 hour. You don't have to wait for this line to go green all across. You just look at the speed of the trading chart that you have. The reason I put up multiple time frames is to show you it can be done if you want to, and it's completely modifiable that way. And you can trade as many financial instruments as you want. You can trade the whole NASDAQ 100. You can watch. You can handle 100 stocks. You can trade the whole S&P 500 and monitor that. And you can mix and match stocks, futures, and Forex. Because the bottom line is what we're tracking on all of them is a common independent force, and that is big institutional money. Now, I wanted to show you a trade. I'm going to show you the end of the trade. Now, everything on this chart we're going to discuss. We're going to discuss it fairly briefly, but the candle halo has value. These 3 lines have tremendous significance. The background color, green, has significance. And what everything is doing is tracking the direction of big money. And if we didn't have big money in the market, there would be no way we could get 3 greens, no way we could get green background, and no way could we get this candle halo all at the same time. See, in this whole area here, there's no background. There's no big money moving the market. It's just us. When big money comes in, price moves. And you're going to see that once we break the pivot, price just gets sucked up by that big money. Now, this is crude oil, but it doesn't matter whether a future or a Forex. You're going to blow the market out.
Target.
And you're out. Now, the amount of money this made is unknown. It depends upon the number of contracts in crude that you traded. You traded 2 contracts, you made $300 or $400. Traded 10 contracts, you made a couple $1,000. The point is that here's the only point that matters. It's an extremely low risk, potentially high reward trade. And I always ask my traders in the trading room, what is the #1 goal of trading when you're a day trader or a swing trader? And almost everyone says it's to get winners, and that is wrong. Every day trader and swing trader who ever picked up a mouse and sat in front of a computer can get tons of winners. My son, who knows nothing about day trading or swing trading, if I gave him a half an hour of instruction, could get winners. What all of these traders can't avoid are losers. So that's the name of the game. It's not getting winners, it's avoiding losers. And in order to avoid losers, you have to avoid risk, but you need a system that defines risk. So you can take the lowest risk trades and trade with tremendous specificity. Specificity, which is true positives, which is true negatives over true negatives plus false negatives, is a formula in which you search for losers and sidestep them. If you try to get every winner, which is true positives over true positives plus false positives, you're going to go broke. So there are going to be trades that you're going to get that are winners. Don't set up, and you got to let them go. But if you can sidestep almost every loser, you can make a ton of money. So what I'm hoping to do with that is change your mindset. Don't chase every trade. Don't try to get every winner. Try to avoid every loser. Now, there are three key metrics that determine money flow. One are the correlative markets, which is our neural net. One is the multi-time frame assessment of Laguerre momentum, and one is the multi-time frame assessment of order flow. Now, order flow is a very, very difficult metric to work with. It's because most platforms get it wrong. Because what they do, and you know, if you've heard me talk before, I almost always mention this because it's important. And that is, you know, I sat in so many different classrooms, had so many professors, and there's only a couple that I remember and whose name I remember. And I had a professor named Dr. Galliani. He was of Indian descent. And he used to say, before he was going to say something important, he would say, I want you to remember this for all time to come, for all time to come. He would say that like 9 times, for all time to come. And you should remember this for all time to come. No indicator that does an assessment of price or any metric off your trading chart will ever have the ability to tell you how price is going to move off the right edge. In other words, every indicator that uses stuff from your trading chart has no forward-looking ability. You cannot assess future price if your indicator in any way looks at the information provided to it by your trading chart. But what I want to do here is simply teach you what order flow is as we define it. Now, you're going to see a lot of software talk about the market delta, the volume ladder, things like that, and they're important to understand just so you know the lingo. The volume ladder is simply looking at the dome, whatever you're trading, and at every price level, whether it's a tick, a pip, or a cent, there are buyers and sellers sitting on the dome. When you add them all up, whether you're trading a candlestick or an open, high, low, close, whatever the formation, the sum is the market delta. Now, the supposition is that if the market delta is positive, you have more buyers sitting on the dome, you're going to have buying pressure, and the candle will close to the upside. Here you have 1,812 more buyers than you have sellers sitting on the dome. Candle closes to the upside because there's buying pressure. Here you have 2,985 more buyers than sellers. Now, inside each candle are stacked sellers and stacked buyers. There's systems that will proffer to you. This has the power to determine how price is going to move off the right edge. And you're going to already remember for all time to come that nothing on your trading chart has the predictive power to tell you how price is going to move off the right edge. So this really is weak. But I'm going to show you how we use it way down the road, but we don't use it here. Now, look at this market delta. It's 222 in the positive if the candle closes to the downside. So if you're using this chart that shows us a constantly rising market delta, it's additive, 812, 2985, plus 222, the line's going up. You're going to assume that price is going to continue to rise, and it doesn't. Because what this does not take into account is the aggressiveness of the buyers and sellers. If the sellers are far more aggressive than the buyers, the fact that the buyers are in excess is irrelevant, and the sellers will control the direction that the candle closes. So let's say this is a stock that has a $50 per share value, and the buyers are only willing to buy it from you for $50.01. But the sellers are willing to give it to you for $49.99, $49.98, $49.97. They are so sure When I say give it to you, I mean take it from you at these lower price levels because they're positive that this stock is going to fall. And because they're so aggressive, they overdrive these buyers. This is what is so difficult to do when you trade a market delta. But there's a way to overcome it, and that is at least one standard deviation's worth of data is going to close in the right direction. So what we have to do is find a way to throw out the outliers, and we do. And here's how we do it. First of all, if you remember, we never look at anything on our trading chart. We only look at the 2 higher time frames. Now, the triple screen method of trading is not something that I invented. It was invented by Alexander Elder in 1997. And I read his book in about 2001, 2002. And he made millions in the stock market trading that triple screen, ignoring what was going on his trading chart and only looking at what was going on the 2 higher time frames. And he did it in a time when charting was very primitive. We didn't have the ability to create these elegant assessments, but he only looked at the higher time frames and traded off his trading chart. Now, the higher time frames are coded into the indicator itself, and I'm going to show you how they work. Now, if you're trading a 2-minute, you take 2, multiply it by 3, you get a 6-minute. That's one of the higher. And you take 6, multiply it by 3, 18-minute is your second higher. Now, let's say that you're trading a 5 range. Now Fibonacci does have symmetry in nature, although it doesn't have it's not going to tell you about market sentiment. So if you're trading a 5 range, the 2 higher time frames are the 8 range and 13 range, the 2 higher fib numbers. If you're trading a 377 tick, the 2 higher, the 610 tick, and the next higher fib number. So you're only going to look at the higher multiple time frame charts, and you're going to ignore everything going on your trading chart. In fact, if you link this to your trading chart, it destroys the validity of the assessment. So what we do is we place these market delta values into a 15-period simple moving average. What that does is, what you're really looking at is the average market delta going back 15 candles on the 2 higher time frames. So occasionally when you get a market delta that closes in the wrong direction, or the candle closes in the opposite direction of the delta, it's smoothed out because you're looking back 15 deltas, and you're not looking at your trading chart, you're looking at the higher time frames. And the only thing that can make this alignment is big money. So when both these 15-period SMAs are sloping up, the bulls are firmly in control, and it's institutional money that's doing it. When both these 15-period SMAs are sloping down, the bears are firmly in control, and only institutional money can create that alignment. When we're in control of the market, the small retail trader, we don't get any alignment, and our order flow line is flat, is yellow, and that tells us that we have no alignment. And that's when we're going to stand down, because our goal is to avoid losers. Here's an example. This is that SMA 15 on the 2 higher time frames, heading down, heading down. What's the likelihood that price on your trading chart is going to go up? Slim to 0. So you have to trade in the direction of these 2 SMAs on the 2 higher time frames based off the last 15, the average market delta value. And here's an example. Price falls. Here's our order flow line. It turns green, and you see you get the move up. And price is almost always going to rise into a green order flow line. Now, look what we have here. Counter trend trader, counter trend trader. What are they trading? First of all, they're calling a top. And the top is not going to occur until institutional money steps aside. As long as big money is pushing money into this financial instrument. Now, I purposely didn't tell you the time frame, and I purposely didn't tell you whether this is a stock or future or a forex, because the time frame is irrelevant and the instrument's irrelevant. It doesn't matter. But these traders are calling a top. And what are they using? Divergence, Fibonacci resistance, price patterns, Japanese candlestick patterns, and they are definitely going to get beaten up. In fact, we rely on these small retail traders to help our trade go higher, because what's going to happen is they're going to sell their contracts, short their stock, sell their lots, and as price moves higher, they're going to get squeezed and they're going to have to buy it back and push price further up to the upside. We're never going to be in these candles ever again. Now, Laguerre momentum, or the Laguerre oscillator, is different from all the other oscillators. RSI, the Arun, Williams R, stochastic, slow and fast, were created based on the same mathematical formula to do one thing and one thing only, to track and find divergence. And if I put all of those indicators up underneath the same price action, they would trace out. Some of them are a little bit different, but especially RSI. But the bottom line is they're looking for divergence. Their primary goal is not to track momentum. Now, George Lane developed this whole premise as I mentioned, in 1963. And remember that momentum is a second order derivation. What it is telling you is about price acceleration, not speed, but acceleration. And what is acceleration? It's the close of the candle is inching to the low of the candle. And as the close continues to inch towards the low, price is accelerating to the downside. Now, the only thing that could take the Laguerre and push it to zero and flatten it along the zero line like this is big money. And that's what we look for. Now, the Laguerre's formula is radically different. It has a gamma and multiple smoothing factors. We have modified it because we don't care about divergence. The Laguerre rarely gives you divergence. All we're looking for is a multi-time frame alignment in momentum. We want price accelerating in the same direction on our two higher time frames. And that's what we do. Same assessment, two higher time frames. We can't use our trading chart or it'll confound the assessment. And when both momentum lines are sloping up, the bulls are firmly in control. Again, only institutional money can do this. When both momentum lines are sloping down, bears are firmly in control. Only institutional money, it's red. And when the line is yellow, it's us. And we don't trade. And here's that percent K line. Now, when that percent K line is moving up, it means price is accelerating to the upside on our two higher time frames. And if we try to counter trend trade or not go long in the same direction, the likelihood of us getting a winning trade is extremely small. I mean, it's pitifully small, actually. So let's combine them. So now we need order flow and momentum to be both aligned in the same direction on any trade we take. We're trading now with more and more specificity, harder to get an entry, but the entry has more and more validity, and the predictive value of the entry is starting to rise. So when you take it, the percentage of winners you're going to get is getting pushed up. Here, it's going to turn before price, and down you go on the first pivot. Here, it's going to turn before price, and up you go on the first pivot. And you can see that it leads price. Now, the quant line is our neural net, and it's a very, very novel assessment of the market. Now, here is our quant line. Now, you already know it can't be looking at the E-mini in our trading chart. If it did, this line would have no value whatsoever. We already know that it's doing a multi-time frame assessment. But in this particular case, it's not even looking at the E-mini. Here's what it's doing. It's creating a small neural net. We are looking at the correlative markets of the E-mini. And what are they? The Dow, the Russell, and the NASDAQ. So in order for this line to be read, we ignore the E-mini. We look at the multi-time frame direction of the Dow, the the Russell, or the NASDAQ. If all three of these are not aligned to the downside on a multi-time frame basis, this won't go red. And here, if all three of these are not aligned to the upside on this long trade, this will not go green. So what's the likelihood of taking a winner or a loser on the E-mini short when the Dow is falling, Russell's falling, NASDAQ is falling, and they're all doing it on a multi-time frame basis? Well, the probability is extremely low. Now, the reason we call it a quant line is because the NASDAQ and the E-mini have a very tight correlation coefficient, almost 0.9. So the NASDAQ is given more weight in this line. It's quantitatively weighted more heavily. But every single financial instrument has its correlative markets. And what makes this software so complex is that you have to have a different quant line for every market that you trade. But that's part of the package. We give them to you. So what we're looking at is the multi-time frame direction of the E-mini's correlative markets, the Dow, the Russell, and the NASDAQ. With the NASDAQ weighted the most heavily, the Dow weighted the least heavily, and the Russell in intermediate. And we've created quant lines for almost all the futures markets. If you can find a futures market we don't have a quant line for, we'll make it for you. Again, I mean, every Forex pair that I think you'd ever want to trade. And we have hundreds of stocks. If you come up with a micro cap stock that we don't have a correlative, we don't have a quant line for, we'll make it, because no stock moves in isolation. Now, here's all three lines. And when all three are not green, 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 or red, 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 we don't trade, because that defines chop and allows us to sidestep losers. When we get green, 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 we have to trade long. When we get red, 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 remember, first line is the correlative market line or the quant line. The second line is momentum. The third line is order flow. And on a multi-time frame basis, when all three of these are aligned, I mean, it's going to be very difficult to counter trend trade them. Now, I automated this to really highlight it because it's so important. Now, I trade Unarenko. You don't have to trade Unarenko. You can trade any candle formation you like. But the reason I trade Unarenko is I don't care about Japanese candlestick patterns. I used them for years and they don't work anymore. I don't trade rising and falling triangles. I don't trade those kind of price patterns because they have no validity anymore. The only thing that matters is the direction and the flow of institutional money. And you see these counter trend traders, they're calling a bottom. And at every single time they get run over. And again, they're using price patterns, all the things I went over, Elliott wave, Fibonacci. It does not matter. Only the direction of big money. And here's what you do see a lot of times in the market. You have 3 reds. Now, when there are 3 greens, you can only go long. When you have 3 reds, price is going to fall. You're going to get retail traders trying to push price in the counter trend direction. We're never going long. We're going to let the retail traders push it up. We're going to take the first pivot to the short side, run them over, and let them help us push this particular instrument to the downside. Let the small retail traders have their say, and we're going to run them over. Let this group of retail traders also call a bottom. We're running them over. And we will constantly run them over until this moves back to chop. Institutional money stepped aside. We can no longer anticipate a continued move down. Now, we do use one indicator that just assesses price on our trading chart, but you need to have the signal it creates validated by everything else. This is we call it our exponential oscillator, and we simply took the regular stochastic formula, raised it to the second power, created an exponential assessment from an arithmetic assessment, and when you get this %K line cross this cyan line, you're going to get a blue up triangle. When it crosses here, you get a down red triangle, blue up triangle, down red triangle, blue up triangle. Now here's your perfect trade. All green, oscillator cross, the entry's validated, and up you go. Here, triangle, but it's validated. Now you're going to get a lot of triangles that are not validated, and you're simply not going to trade them. You let them go. It's the multi-time frame assessments. They're going to give you this okay to take that trade. Now you can get huge moves as long as institutional money stays in the trade. Here's the cross. Hold on, let me mute this. I'm sorry. Here's the cross. There's the oscillator signal. Now the candle halo has a lot of validity. I'm going to tell you what it is right now. That this neutral candle halo, which is black, doesn't matter. When the candle halo turns in color, you have to exit the trade. And it only looks at order flow. Now, in this particular case, all the lines changed: order flow, momentum, and the correlative markets. But order flow is the most sensitive. So when you get a change in candle halo, what we're trying to do is have you focus in on price and not have to be always looking down at these 3 lines. The one that's most likely to turn first is order flow, and you can make this candle halo any thickness you want, any color you want. I like to make it magenta and blue. You can make it green and gold, whatever you like. Here's the downside, oscillator signal, and down you go. You're out on this blue halo. And remember, you're out on a down candle. Remember I told you that this leads price? And that's very rare to be able to close a trade that's still falling, because the likelihood is right here is where it's going to turn. And sure enough, it does. Now, the next exit, mandatory, is the cross of the oscillator in the opposite direction. It just so happens that order flow turns first and you're out. So those are the two exit signals: the change in candle halo color or the oscillator signal in the opposite direction. You must exit the trade. So we want to throw everything in that we can in our favor. We want the multi-time frame assessment of momentum, order flow, and the correlative markets to be in our direction. We also want the instrument we're trading to be in a multi-time frame alignment in the direction that we're going to trade it. We're trading Google long. We want Google to be in a multi-time frame uptrend. If we're going to trade Netflix short, we want it to be in a multi-time frame alignment to the downside. You can see how important that is and how much it adds power to your entries. So what we do, there's 3 different down powers because it's a pretty complex assessment. The most powerful alignment to the downside is dark pink. Most powerful alignment to the upside is dark green, and this is background color. And it does not look at price on your trading chart. Like 99% of the software systems that have that background color, all they're doing is looking at price on your trading chart and telling what you already know. So when you have background color, dark pink, it's very unlikely that you're going to get a move to the upside as part of the overall trend. You can see price comes down, it pulls a little bit up, it consolidates, then it drops precipitously, but over time, price is going to evolve to the downside. Same thing with the upside. Now, these are 3 different powers. Dark green's the most powerful, cyan's intermediate, light blue is the weakest. We will go over all of that in a master class if you come aboard. But the most important thing is through all these colors, price is aligned to the upside on a multi-time frame basis. And although it can meander, it's going to rise. Now, the last thing that I'm going to show you are the pivots. And then we're going to look at some trades. Now, pivots are very important. Every time price turns, it means buyers or sellers have come in to change the direction of price. And our system creates very unique pivots. They're tough. They're the way the Japanese rice traders wanted pivots to be created, but very few software packages do it because it's a tough way to create a pivot. We don't do it at a wick low, we do it at a candle body turn. Now, these thicker areas, remember you saw those stack buyers and stack sellers? Well, if there's a multi-time frame alignment of those stack buyers, you know that there's a lot of buyers sitting in these zones. And what we call these are buy-sell zones or zones of buy-sell imbalance. And there's a lot of buyers here on a multi-time frame assessment. We never trade into them. They're very hard to break. They do break, but you can trade into them 4 times and lose until they do break. You can see price comes down and bounces, down and bounces, down and bounces, and then straight up. Goes up and bounces, up and bounces, up and bounces. Now, it may go right through, but when we cannot determine whether it's going to break or hold, we must stand aside. Now, if you want to trade an option, and I'm not going to go much into options in this class. In the master class, I'm going to go into options a lot. You all get that class. When you get a long call, you can buy in the money or at a long signal. You're going to buy in the money or at the money 1 week out call. Downtrend, you're going to buy an in the money or at the money 1 week out put. Now, if it's a Friday or a Thursday and you get a nice run, you can make a lot of money. Like I said, 7 days in or at the money. Gives you a nice delta For every incremental change in price, you're going to get a nice zip in the price of the option. Now let's put it all together. And I'm telling you, it's a lot easier than you think. You're going to get an exact entry, an exact exit, and your targets will be all pre-configured. Now here's an entry, oscillator cross on a Vago. It's a 2-minute chart. I like to trade minutes on stocks. You can trade Renko, you can trade range, you can trade Unirenko. This is just my personal bias. I like to trade time. On a 2-minute, this is a $10.12 move. You see the oscillator cross here, and you see the down, it's almost eclipsed, but there's the down triangle, and you have to exit the trade. It's a $10.12 move on a 2-minute. If you buy an at-the-money call, you made a lot of money. And if you have enough money to buy the stock, it's a great move. Here's Fiserv. There's your cross. Down you go. The candle halo stays. Candle halo changes. You must exit the trade. It's a 9% move on a 10-minute chart, $7.05. Here's Google, and it's a $51 move. It's a multi-day move. It's a 30-minute chart. You can trade any time frame you want. You can trade a 2-minute, a 30-minute, a 4-hour. We just had somebody call us and ask us to create for him templates on a monthly, a weekly, and an hourly. And he's one of our clients. We've made him the templates, and they look beautiful. Doesn't matter what time frame you trade. There's your signal. Up you go. The candle halo stays intact, and you have to exit, even though it seems like institutional money is still pushing this up. When this oscillator crosses and you get that down triangle, you have to leave the trade. $51.66 on Google. An at-the-money call is nice. Is really a nice amount of money. This is a $100 trade on Amazon. There's your triangle. There's your move up. There's your cross, just crosses. Get your down move. You gotta leave. It's a $99.47 move on Amazon. Now, I want you to know you're going to get losers, but your losers are going to be few and far between. Amazon is aligned to the upside on a multi-time frame basis. Momentum, order flow, and Amazon's correlative markets are all aligned to the upside on a multi-time frame basis. We're trading with a rising and green 50, a rising and green 15, and we're trading above the 50. We only go long above the 50 and short below. That's just a rule. Will serve you well. The likelihood of Amazon going against you on this is slim and none. Now, you may not make a lot of money on the trade, but the bottom line is you're going to avoid taking a loser. Now, everyone always asks me about micro caps, and one of my favorites is McEwen Mining. It's got a lot of volatility for a micro cap. Now, this went 8 cents, but we only banked 6 because of the bid ask on the bid ask differential on a micro cap. 8.5%, and it doesn't matter. I mean, you can trade a 70-cent stock. It's just as effective as trading Netflix or Google. Now, in McEwen Mining, I recommended to buy at 50 cents. It's now trading over $1. If you trade the SPY and the Qs, this is a terrific system. Here's a short on the SPY, all the way down, out on the oscillator signal, $17.24 on a 10-minute. You're trading options on the SPY. I'm telling you, you're going to bank money. SPY on a 30-minute, $26.44. The SPY is aligned to the downside. We already know we've got all the metrics aligned. the chance of the SPY turning against us are slim, very slim. Here's the Qs. I mean, the system eats the Qs up too. There's the entry, there's the fall, and there's the exit. Again, you may not make $6.78. Maybe you make 42 cents, or maybe you make $12. The bottom line, though, is if you've got an absolute signal to exit and the likelihood of the trade going against you is extremely low, the software allows you to make a risk assessment, and it's a very precise risk assessment. That's all you can ask software to do. Here's an up move on the Qs, 478 out on the oscillator cross. Now, crude oil, I like to trade on a Unirenko. There's your entry. You see how just order flow changed? Candle halo changed. You have to leave the trade. 73 ticks on a 2-5-10 Unirenko. Gold, I think gold is a very tough instrument to trade, but there's the oscillator entry. Up you go. Now you're out on the cross, back in on the cross, back up for another winner. This is a 44 tick trade on a 2-5-10. On the E-mini, 10.5 points. Order flow, the whole thing is in your favor. Institutional money is pouring into the E-mini, and you're going to make a nice move. See right here, order flow went red. As soon as it does, candle halo changes, and you're out of the trade. Same thing with Forex. 24 pips, 66 pips. Big institutional money governs the direction of price on every financial instrument. 32 pips on a 220.30 Unirenko on the euro dollar. Now, here's our net profit for the year in 2019. In fact, it's not quite, it's 11 months, it's not 12. We were up to over 130, and we closed just above $120,000 in 1 year. Now, I have 3 testimonials I'm not going to play. The last one is by a man from the Florida Chamber of Commerce, and we're down in Florida. They're all very, very credible and real and honest. And these 3 traders are in our room, and they make a lot of money. I'm not going to play it. Now, if you do achieve trading success, it's the old story, but it's true. You do gain financial freedom. No financial pressure. You work from home. You have no boss. You have no commute. And look what's going on now during this COVID epidemic. I mean, if you can day trade or swing trade successfully, you have no financial pressure, and there's 20 million people unemployed right now. So it's really a blessing and a gift if you can master this skill. But you need the right tools. Archimedes, when he invented the lever, said, "Give me a lever and I will move the world." And he was a little histrionic when he said that, because there's a lot of things you can't move with a lever. But let me tell you, if you can day trade and swing trade and make money on a consistent basis, the sky's the limit for you. Now, here's the system, and it's got a lot of really good add-ons. I'm going to show you something at the end that you're going to find really, really, I think, interesting. Now, it's easy to learn, and you can see the workspace is very intuitive. Now, it's going to take chart time, because you may, depending upon what you want to trade, it's going to take a little bit of work. I always say, if you bring to the table discipline and patience, I will bring to the table a software system that works. And if you can leverage it with those 2 things, discipline and patience, it will make you money. It's great for beginners, and I think beginners are the best traders to work with because they don't have to unlearn all the junk that's been pounded into their head by the marketers who have never taken a live trade in their lives. And if I could go down the list, we would be here for an hour of people who have been proffering trading systems for over 2 decades and have never taken a live trade in front of me or anybody else in their entire career. And it works on any account size. It depends what you want to trade. If you want to trade the Forex, it takes very little money. Futures too. If you want to day trade or swing trade stocks, it's going to take more money. And the offer is for a purchase. It's not for a subscription. There's no monthly fees. Now, the other thing I want to tell you is it's configurable to be used on any platform, but the indicators will only work on NinjaTrader 8. But if you have thinkorswim, we can bring thinkorswim as an API, and we can bring the data feed from thinkorswim and bring NinjaTrader 8 to life. And NinjaTrader works perfectly. If you have eSignal, if you have Interactive Brokers, if you have Oanda, there's a whole bunch of brokerages that who have created APIs that will run NinjaTrader 8. So basically, you get NinjaTrader 8 for free. You're not going to have to pay platform fees for it, and you're going to run it off of your broker's data feed. Here's the market scanner that I brought to your attention before. It's part of the software. It's part of the system. Now we're going to give you a rapid results quick start guide. If you're technically inclined, you can set it up yourself. If not, Sergio here has a master's in computer programming. He will log onto your computer, set it up for you, and if you ever have a glitch or a problem, or let's say you want to trade a different time frame, you need a different template, we'll create everything for you. Let's say you want to trade a new stock and you need the quant line, we'll make it for you. Now, this is really important. Since you own the software, you still get free lifetime updates and upgrades. Like, I was hoping we would get it tomorrow, but on Monday, we're going to get an indicator that's going to actually give you an audible alert when everything is aligned on your trading chart. It's sort of like the signal you get on the market scanner, but it's going to appear under the candle with an audible alert. And you can set it up on as many charts as you want. So it's actually going to give you the entry based on everything I discussed aligning. Now it's going to occur intra-candle, so you have plenty of time to set up your buy stop or your sell stop, buy one tick above or sell one tick below, and we're rolling that out and you get that for free. We make a new indicator or something new, you get it. Again, you have unlimited support. We're always here in the office to help you, always. A lot of times you'll buy software, you'll call, you'll get voicemail or a answering service. We're always here, 24/7 almost. In fact, Rory's on call. Don't call him at 3 o'clock in the morning, but if you call at 8 o'clock in the morning and you really have something that bothers you, you're going to get somebody who actually picks it up for you. You're not going to get an answering service. Now, you're going to get, every month we have coaching calls, and we have about 300 people in the coaching call. And it's open chat. There are all the traders on the system who are still connected to us. And you're going to trade ideas on how to trade. A lot of them are brilliant. They're going to give you their insight, and I'm going to moderate. If we have upgrades, we're going to give them out. If we have add-ons, we're going to give them out. Everybody gets everything for all those upgrades and add-ons are at no charge. And some of these traders are brilliant. And what we have is a very, very supportive community of small retail traders. And our philosophy is that we can never take money from the institutional traders. They create the trend. If we're not 1/2 footstep behind them, we're going to lose the trade. We have to be right behind them. And we want to be the retail traders that beat up all the other retail traders. If you go home with $600 at the end of your trading session, you've taken that money from the other retail traders. You haven't taken it from the institutional guys. You've traded with the institutional guys. And that's why we're so supportive. In the live trading room that I trade every morning and in the coaching call. Now, it all adds up to 68, 65. I'm not going to go through it. Now, the cost of the whole system for life is $997. And it's capital M, it's Money Flow Tracker 3. You have to enter that as the promo code, or you're going to get that $6,000 figure. Capital M, capital F, capital T with a 3. Now, if you order today, you're going to come into the trading room and trade with me for a month. Now, I'm a little bit different than the other trading rooms. I actually call the trade in advance. There's nothing illegal about it. You can do it. And we actually trade and create an equity curve. And at the end of every trading session, we go over all the trades, because you can make money on a bad trade and you can lose on a perfect trade. Now, so I call them in advance. It's going to skyrocket your learning curve. Now, I couldn't do it today, but on, what's today, Thursday? On Tuesday, I taught for 2.5 hours after the trading session. I teach a lot. It's not only a morning of trading until we hit our profit target, which is $400 to $600. It's also a big educational session afterwards, because I go over all the questions and then I just teach. I teach you how the system works, and I'll teach you whatever you want. Now, it's really a mindset. If you're not making money, if you've been in the market a long time and you're just treading water or you're losing, it's in your best interest to make a change. I'm telling you the system works. And this is an opportunity to take action. So you can sit on your hands and do nothing. Now, if you're making great money in the market, maybe this can help you make more. But if you can't make consistent money, if you bring discipline and patience to the system, it will work for you. Now, I'm going to show you one more thing. I just want to put this up one more time. Also give you our phone number, 786-732-4656. Now, using the system, I'm going to show you. I took this right off our newsletter. This is our options alert newsletter. And these are the trades that just went out a couple of days ago. And what I did, I wrote Russia and Saudi Arabia are better equipped to handle the meltdown in the price of crude oil. This index fund is supported on the back of Shopify and can't go on, and that can't go on forever. The Canadian economy is in for a rugged time. We shorted MCI, the MCI Canada Index Fund. I recommended a buy on Laboratory Corporation of America on a 150, 155 call spread, because they had just come out with a at-home COVID test. This thing exploded. My third was Caesars Entertainment. Now, all of this has to comport with the technicals on the trading chart that we use. Caesars was sitting right at support, and I saw cluster buys on Caesar, one after the other. I have a data feed for options, and I look for cluster purchases. Now, if you go out there, they're called stealth trades, and you can buy these stealth trades for $2 grand for a year, but they're not stealth, because all you have to do is buy an $80 data feed called Benzinga Pro, and you see them all. So many traders were buying Caesars that I put in for a $9 call with an expiration of June 19th. And my fourth trade was Barrick Gold, and it was a day trade. It already exploded through the roof. Now it expires tomorrow. We're already out of it. The first day we were in it went up 114%. So those were the recommendations. The trade updates, I took a spread on Facebook. It is flying. I took a spread on Expedia. It is flying. I took a spread on Microsoft. It's doing great. And I took a spread on Logitech, which is the world's leading maker of cams. Now, I think we're about ready to sell it. I gave it to May 15th as the expiration. I think it's almost at 48, and we're way in the money on it. So I'm probably going to dump it. So what I'm going to throw in for this session only is you're going to get 6 months of those options alerts. If you come aboard today, and I send out probably at least 2 a week, and I'm a terrific options trader. I use the software. I'm going to teach you how to do it, but I'm going to teach you how to leverage it with fundamental information, which comes in across the data feed. Here's where the technicals and fundamentals have to match. And when they do, you get a terrific trade. I saw huge trades crossing on Facebook, trades crossing on Microsoft. I knew that big money was there. I followed. Facebook was a perfect buy. Microsoft was a buy. To be honest with you, Laboratory Corporation of America, I just bought because they invented the first at-home AIDS kit. I just grabbed a call on that. I knew that was going to take it up. But for all the other stocks, I mean, you know what? That's called a catalyst event. And you don't get many of those. What you have to do is trade the fundamentals and the technicals. And I don't trade price to earnings ratio. I look as big money out there buying huge call options, and I'm very successful. So let me see if there are any questions. I'll be happy to answer them. Hang on. Now I have to go, no, okay, because these are questions all the way from the start. And when did I start? Okay, so there are questions here. Okay, yeah, yes, we do work on Thinkorswim. Hey, Joe, thanks for coming aboard. I really appreciate it. Like I said, you can trade any stock, any future, any Forex that you want. There's no problem with that. Steve, yes, any upgrades, like I said, any upgrades, any add-ons, any improvements we make in the system, you're going to get for free. You're never going to pay us another dime for the software. And you get a month in the live trading room for free. If you decide to continue on, it's because you find it to be tremendously helpful from both an educational standpoint, and I give you great trades to take. So you can call us at 786-732-4656 or sign up. I hope to see you in the trading room. And either way, I really wish you the best. I really want you to be successful. And you can call me anytime, even if you're not a member. I'm always here to help you with any trading questions that you have. So thank you so much for your time, and have a really, really wonderful day. Take care, everybody. Bye-bye.